and we're incredibly excited to be hosting Terry Markiniak. Terry, apologize if I butchered the last name.
Maturniak, it's not as bad as it
Maturniak.
sounds.
So Terry is the founder and managing director of Apex Capital Advisors. He has over 25 years of experience within the tech sector. Being a serial founder himself with two very successful exits, having raised over 20 million in venture capital himself, and also supporting over 250 million in M&A transactions with other types of ventures that he's supported. Terry has a wealth of experience working across various verticals. He was previously the executive director of York Angels, and he's also been formally trained as a lawyer from the Osgood Law School from York University. So lots of great experience and expertise that Terry brings to this topic himself. So Terry, over to you.
All right, thanks everyone. Let me just share my screen. Yeah, so there's a reason I have all this gray hair, because I've done 4 startups, 5 technically, I think, and I've been on the growth and development side for many years. So, okay, so I guess I'm coming in at the tail end of your series. So, so Apex, my firm, we're M&A advisors in the tech sector. So we help founders and CEOs sell or exit their businesses.
Yeah. Oh, yeah, exactly. That's.
I think somebody has their mic on. If you guys can just turn your mics off, please, that'd be great.
And so we advise companies on how to get ready for an exit and ultimately execute on exiting their business. So this webinar series is meant for a little bit more mature companies, but a lot of these metrics and things we're going to talk about apply to early stage companies as well. We preach that you really need to start thinking about your exit years ahead of when you're actually ready to do it. So let me just dive in. I'm sorry, I'm just gonna want the slideshow. Okay. So where do you start? So founders have to think about many things when they're considering selling their business. What are your financial objectives? And that may sound like a dumb question. Naturally it's I want to get the most money for my business, but it's not that simple. So you have to think about whether or not you want the most cash up front or the highest valuation. Those two can be very different. Are you selling 100% of the business, a control stake, a minority stake? We work a lot with private equity firms who often do not buy 100% right out of the gate. They'll buy a controlling stake in a business, build it, and then exit, 3, 4, 5 years later. Other things to think about is, are you willing to take back a note? In other words, not all of the purchase price is cash, but some of it is in a loan that gets paid out over years. And also, a really important thing is, are your valuation expectations reasonable? Many times founders have a bit of a flawed sense of the value of their business, particularly since you've raised venture capital, and venture capital valuations are not the same as real world acquisition valuations, because venture capital valuations are often inflated so that every round is an up round, and there's certain dilutive factors that get impacted. So you need to think about whether or not, when you're ready to sell, are your valuation expectations rooted in reality? And the other thing is, often founders are building their business for 5, 10, 15, 20 years. Are you ready to part with your baby, right? It's a bit of an emotional attachment with many founders on their company. So sometimes they think they're ready to sell, but they really aren't, or they really, need to think about what happens with your business and what happens with the legacy of the business that you started. Okay, so just some general high-level considerations when you're starting to embark down this path. And we often tell founders that it's probably a 2-year process between when you decide you want to sell and when you actually sell the company. And it's roughly a year-ish to get ready, and 9 to 12 months to actually execute a transaction. Okay, other considerations to think about. Are you looking for a second exit with additional upside? So again, oftentimes, not so much strategic buyers, but private equity buyers want founders to retain a stake in the business. They want you to stick around for anywhere from a year to 5 years, and sometimes we'll give you a second kick at the can because you're going to get equity as part of the purchase price. So again, you got to think about what are your personal objectives when you're ready to sell, right? At a minimum, generally a buyer is going to want the founder to stick around for about a year. Sometimes we can do it in as little as 6 months, but probably a year is a reasonable number. And then you have to think about, do you want to stay long-term with the business? Or do you want to, check out and get out of town as soon as possible? Other things to think about are employees. Do you care what the acquirer does with your staff? And is that a deal breaker? Some, especially strategic acquirers, will come in and, especially if they're in the same business or same industry, they will do a little bit of a slash and burn approach. So they're going to start culling the herd and trying to find integration synergies. So again, you need to think about, do I want to protect my employees? But if you do, that's probably going to come at a bit of a cost. Think about whether this is the right time or to do it now, or does the company need to reposition or repackage itself? We often talk to founders who say, I want to sell the business, and they say, I want to sell the business for this value. And we tell them, well, you're not ready yet. You haven't done this, this, and this, or you have to grow into your valuation. So oftentimes we will help founders on a bit of an advisory basis for 6 months, a year, sometimes 2 years, to sort of better position the company or repackage itself in order to maximize the value. Other things to think about are sort of geopolitical, economic factors. Sometimes it's not the right time to sell a business if the economy is in a recession or the M&A market is in the doldrums. So something to think about. You don't really want to base the decision on trying to time the market. That's never a good idea, but it is a factor to consider. And then the biggest thing we preach is start planning ahead. Start talking to your advisors. And again, it can be a 1 to 2 year process to get your company ready. Even once it's at a certain scale or size that you think you want to exit. Okay, so the first thing you got to do is surround yourself with good professional advisors. You need a team. Any CEO that thinks that they can run the business and execute on an exit strategy by themselves is delusional. You really need a bit of a team to help you with this. I like to tell founders that when you're embarking on selling a business, you all of a sudden have 2 full-time jobs, and it really is that time intensive. So don't underestimate the magnitude of the task of selling your business. Now, anyone can sell the business quickly to a suitor that comes knocking on the door, but it is a long, rigorous process to sell it for the maximum value to the right buyer. So give that some thought. And again, you got to engage your advisors early in the process and create a plan. Just like you create a plan to raise capital or you create a strategic growth plan, you need to create an exit plan, okay? And again, utilizing your own people. Oftentimes companies like to use their CFO as the person charged with selling the business. That's not a good idea. Number one, CFOs they're not trained to do this kind of work. They're important parts of the team, but that's not what they do, and they've got another full-time job. So again, you might save yourself a little bit on fees on not hiring an M&A advisor, but in the long term, you're going to get a much higher value by hiring professional advisors. And having an independent advisor at the table can also serve as a bit of a buffer between an acquirer and the seller. And it also just gets someone that's objective, unbiased at the table that can give you some perspective. Too often, founders are in love with their baby. It's kind of the thing where nobody can tell you your kids are ugly, but sometimes your kids are ugly, right? And sometimes they have warts and it's good to have an objective person at the table to help you with that. Okay. So types of advisors, I think you should consider engaging certainly lawyers, but make sure your lawyer or your law firm has someone who specializes in M&A work. M&A work is different from general corporate counsel work. You need someone that does M&A work every day, all the time, especially in the tech sector. Okay, that is a very unique skill set. Accountants, you need a good accounting firm, even beyond just doing your year-end financial statements. Either your accountants or your CFO really need to have a rigorous and robust financial model and rigorous financial processes and processes in place, right? You're going to need a tax advisor, which could come either out of your law firm or your accounting firm. And oftentimes, especially if you're going to look for a big exit and you've built up a lot of value in the business, you need good tax advice. Because if you want to create a family trust or do some other creative tax structures, you need to be holding your shares for 2 years. You can't do it on the cusp of a transaction, okay? Certainly an M&A advisor, as we talked about, because that's what M&A advisors do. They help you get the best price for your business, and they also do the heavy lifting while you still continue to run the business. The one thing that I've seen happen time and time again is CEOs get engrossed in selling the business. They take their eye off the ball, the business suffers, and then once they're much deeper into the process, the buyer sees that the company has underperformed the last 1 or 2 quarters, and it puts up a giant red flag. So you really cannot take your eye off the ball in terms of driving revenue and profitability while you're going through this process. I think it helps to have a wealth management advisor as well. They can help you create a plan for managing your wealth. And if you don't have one, get a CFO. Whether it's a full-time or a fractional CFO, you have to have really good financial documentation and a really robust financial model for buyers to probe, okay, and understand the business. And if you don't have that up front, you're just going to end up creating everything on the fly, and it's going to be a mountain of work when you're in the middle of a transaction. And by the way, if anyone has questions, feel free to put up your hand or ask them. So I'm happy to deal with them now, or we can deal with questions at the end. Okay, so when you're thinking about selling the business, it's, I think the first and foremost, you just need to build a really good business that's growing healthily, that's scalable, that's profitable. So that's your paramount consideration. But once you're sort of at that stage, you need to start thinking of who the ideal buyer for your business looks like, okay? And we kind of look at it in 4 buckets. There's strategic buyers, and there's 2 types of strategic buyers. There's ones that are similar to your firm, they're in the same industry, and they're just looking to achieve scale. So for example, we're hired on a buy-side mandate right now for a company that's doing what's called a roll-up, which is an aggregation of multiple companies in the Microsoft Dynamics space. So they're just looking to buy similar Microsoft Dynamics ERP or CRM companies. And, we're buying 10, 15, $20 million companies, and they want to aggregate these to $100 million. And the reason they do that is because once you get over a certain scale, then the multiples on valuations grow quite rapidly. So that's what's typically called a roll-up. Then there's strategic buyers who are in a similar or adjacent space that are looking for something unique that your firm may have. So you may be in a different geographic market that they want access to. You might have different distribution channels. You might have complementary products or a completely new technology that they don't have, right? So there's all kinds of intangible reasons why a strategic buyer would buy. So this isn't a function of scale. This is a function of having either a broader service offering improving distribution and sales, or getting access to new geographic markets, right? So there's lots of reasons why strategic buyers would buy a company. Often strategic buyers, especially if it's a technology company, if it's really core or strategic to them, they can overpay. But strategics are also notoriously slow and very difficult to deal with, whereas financial buyers or private equity firms are used to buying companies every day, so they have a much more streamlined process. And just a small example, some of these intangibles would be when companies like Microsoft bought LinkedIn or Salesforce bought Slack. They're not in the same line of business, but they bought those companies for very strategic reasons, to sort of grow their footprint and their service offerings. Okay, then there's financial buyers. Sometimes you'll get what are high net worth individuals or search funds. A search fund is really one or two individuals that wants to buy a business and run it, and they are backed by financial investors or even a private equity group. And then there's private equity firms, family offices. These are large, anywhere from a couple $100 million to tens of billions of dollars of pools of capital that buy companies. And they're usually sort of specific to certain industries and verticals and sizes. But private equity firms are generally looking for more mature companies with significant stable cash flow. So typically they're looking for about a minimum of $3 million in EBITDA or bottom line. Some look for 5 million, some are as low as 2 million. The 2 million is probably the cutoff point for private equity buyers. And they realize they make a profit by growing a business over anywhere from 3 or 4 years on the low end, as much as 7 years, both through organic growth and inorganic growth. So they love doing acquisitions. And as I mentioned earlier, the higher the scale and the more profitable the business, the higher the multiples are for their valuations. So private equity guys look at companies through two lenses. One, as a new platform business. A platform is a new business that is a foundation for adding on other businesses. And usually they want a decent sized business as a platform. And then they also have what are called add-ons or tuck-ins, which are buying smaller, similar businesses that may not need that same scale requirement as a platform business. But again, private equity guys are becoming more specialized these days, and often they specialize in a few verticals. Some are focused on tech, some are focused on industrials, some are focused on IT services. So they're becoming a lot more specialized. But by and large, most will look at B2B business service companies. Okay, so people often ask us, what's better, a strategic buyer or a financial buyer? And my answer is it depends on a lot of factors. Strategics can sometimes pay a higher price, especially if it's a really strong technology fit for either a core distribution channel or something like that. And they will buy 100% of the business. There's no second kick at the can usually, but they are even more risk averse than private equity guys, and they are painful to deal with. They take a long time to do due diligence. They take a long time to negotiate a deal. And oftentimes transactions can hit political roadblocks. So I'll give you a little war story. We sold a company last year. We thought we sold a company last year for about $22 million through a European company, a European strategic buyer. Went through 6 months of due diligence. We're at the threshold of closing. The legals were almost done. A new CEO came into the business, decided to put the brakes on all acquisitions and killed the deal. So we took the company off the market. 6 months later, 8 months later, we sold it for triple what that original purchase price was. And the other problem you have with strategics is, especially with their own people, there's a not invented here syndrome. So they will ask business unit leaders to look at a company, and especially if it's a technology company, and oftentimes they say, well, we can do that. We just have to throw enough money at it. So again, strategic buyers can sometimes get derailed for something that has nothing to do with the quality of your business. So it's a bit of a double-edged sword with strategics. Financial buyers, primarily private equity firms, they're professional business acquirers, right? They can move very quickly. They have an army of people, analysts and M&A professionals that do this. They have a shorter investment time horizon and are a little less patient capital. One challenge with them is they are also risk averse in a different way. They want to steer away from companies that have lumpy or inconsistent profitability. So if you're a project-based business that has big whipsaw swings in your revenues, you're probably not a good candidate for a private equity firm. And private equity guys generally are paying based on a multiple of EBITDA. They're not paying. Now, if you're a SaaS company, then they will pay a multiple of revenue, and we'll talk about valuations in a bit. But they may not pay quite as big a premium for technology as a strategic, but they're way easier to deal with, way more professional, and much less risk in getting into a deal with a private equity firm than a strategic. Okay, so these are just some things to think about as you're getting your house in order. It is a very good idea to have at least 3 years of review engagement financials. You don't need audited statements, but having notice to reader financials is inadequate. You're going to end up redoing them anyways. Buyers will have a lot more confidence if you have an accounting firm at least review your financial statements, and you need a competent CFO. And fractional CFOs these days are not that expensive. A small business maybe needs a fractional CFO for 2 days a month or 3 days a month. But it is really important to have a CFO at the table. And then the other thing is you want to try and clean up your financials. Like some entrepreneurs run an enormous amount of personal expenses through a business, and then we have to go back and adjust those when we do the financials when we're selling a company. That's a pain. The cleaner your financials can be, the better. And then clean up your balance sheet. Don't have dead receivables on your balance sheet. Don't have outdated inventory. Make sure you manage your deferred revenue. Things like that. So you need a good, robust budgeting process and financial model. I can't tell you how many companies we've come across that are, $5, 10, $15 million in revenue and don't even do a budget annually, let alone have 3-year forecasts and a robust financial model. So again, I encourage you to get your financial house in order. You also have to make sure that you have enough, you maintain adequate working capital in the business. And working capital is defined as current assets minus current liabilities, but you want a good ratio. You don't want to be underwater where your receivables are well below your payables. That becomes a problem. Okay, and then if you're getting ready to, if you're thinking about an exit, you can start, prettying up the baby. Look at cutting unnecessary staff or expenses. Oftentimes, CEOs keep people because they like them, they've been with them for a long time, they trust them, but sometimes people are a bit long in the tooth and they really need to go. So you need to be quite mercenary in cutting staff you don't need and trying to improve your bottom line and reduce whatever expenses are, completely discretionary. If you're thinking about investing in a new growth initiative or a new technology that's not going to bear fruit for 2 or 3 years, don't do it, because you're not going to get credit for that investment when you go to sell it, if you're looking to sell it in the next year or two. So again, goes without saying, but use technology where you can to replace humans, improve your bottom line. And again, when you're a year or two away from selling the business, you need to try and maximize that EBITDA or that bottom line. And then look at other things to juice your revenues, right? higher revenues and higher growth rates will translate into higher multiples on your valuation. You know, look at alternative sales channels or strategic partnerships. And you need a strong sales pipeline. If you don't have a CRM system, you better get one, because using spreadsheets is generally inadequate if you have a complex business. So you need to be able to show your sales funnel and your sales processes and your sales pipeline to a potential buyer, because they're partially buying into your growth and the future, not just your historical results. But don't implement short-term fixes that are not sustainable. So for example, you can't just, if you've spent 5% of your revenue on marketing the last 5 years, you can't cut that to 1% on the cusp of a sale, because buyers will see through that. So you need sustainable fixes or sustainable cuts to expenses that the business can continue to run scalably after you've done that. Okay, legal considerations. Clean up your cap table if necessary. You know, we see sometimes very complex cap tables, and venture capital firms love to have different classes of shares, and a lot of times it's unnecessary. And sometimes lawyers will talk founders into having 4 or 5 classes of shares for potential future tax planning. Complex cap tables are just a nuisance and can scare off buyers. Okay, so the more simplified your cap table and your share structure, the better. Deal with any legal issues early. Don't, you know, wait for a transaction to be happening, because you cannot not disclose a potential lawsuit. So if you've got any potential lawsuits or disputes, settle them, get them put to bed. Do not ignore potential lawsuits, because you're going to be giving reps and warranties that there are no lawsuits. So the one thing you cannot do is sandbag and not disclose things early, and because they're just going to come back up in due diligence at some point later. Look at your corporate structure with your tax advisors. Make sure that's efficient. Sometimes companies have multiple operating companies in multiple jurisdictions, multiple holding companies that someone's talked them into, and again, it's unnecessary. So simplicity is key here. And again, just try and make it easier for people to understand that, because the more complex your structure is, the more due diligence there's going to be, and the more your legal fees are going to be. Okay, so try and align your business with strategic buyers. And I like to tell this little war story of one of my own companies. So when I started my second company, my founder and I mapped out 8 companies that we thought would be ideal to acquire the business. So we were in the tech space. It was a sort of a hardware and software business in the energy management space for buildings. And we identified 8 global companies that we thought would be great acquirers. And sure enough, 7 years later, we sold it to one of those 8 companies. And the reason I tell you that story is because when we architected the technology and when we architected our distribution channels and our go-to-market strategy for that business, we had those potential strategic buyers in mind. And again, this particular strategic buyer way overpaid for the business, but we had some critical technology and channels that they needed access to, and that's why they overpaid. So start thinking about who would be the ideal buyer, and then figure out whether or not what you can do to make your company or your technology indispensable to them, right? And a lot of times, big companies will enter into strategic partnerships with smaller companies, kind of to kick the tires as a precursor to an acquisition. And that's exactly what happened with my company. A division of Siemens, we entered into a strategic partnership with the company, and 2 years later, they bought it. Okay, so think about unique distribution channels, geographic strengths, technology partnerships, things like that might sort of be a precursor to an acquisition. And you also need to think about your product roadmap. If you're on a completely incompatible technology platform than one of your target acquirers, like that's a big problem, right? You know, start thinking about building APIs or integration tools with platforms of these target acquirers. So again, once you have that final goal in mind of who would be a great acquirer, it will start to drive decisions you make, you know, sometimes 5 years in advance, and it'll make your company a lot more valuable. Okay, and again, think about large companies like to buy what I call large niche players. It's a niche that is too small for them to start another business unit or division right now. But as you grow it over time, it'll become a big niche and it can become very valuable. And I like to tell founders, get really, really good at something narrow rather than trying to be mediocre at something very, very broad, because that's not going to get you anything. Okay, other things to think about. I'll wrap up in about 5-10 minutes. You know, have proper employment agreements for all your staff. Get a lawyer to draft a proper employment agreement with confidentiality provisions, IP assignment clauses, non-solicitation clauses, and I stress this, reasonable non-compete clauses. Non-compete clauses, most of them are unenforceable when they're too broad or too long. Okay, so get some good advice on that. Make sure you have your IP sort of portfolio buttoned down. Apply for your patents, have those up to date. Apply for trademarks, copyright. And then for technology companies, you need to have a long-term roadmap. You can't be running your technology development by the seat of your pants, okay? So you need a 3-5 year roadmap that lays out what you're gonna develop, how much that's gonna cost, what the resources are gonna be required as the business scales, okay? And that needs to tie in with your financial forecast. So your R&D spend or your dev spend needs to be reflected in your financial forecasts. And make sure that your CTO or whoever's the de facto CTO develops repeatable processes in your development plan. You need SOPs and playbooks for running your business. These are important factors because if you have playbooks for everything around your business, due diligence will go much easier, and you're actually going to get a premium for the business because they don't have to figure all that stuff out by picking the brain of the founder. Okay. Ensure you have good HR practices, including formal onboarding and offboarding processes. And obviously, cybersecurity is a big issue these days. So you need to make sure that you have strong cybersecurity and privacy procedures in place. Okay, so valuation. Everybody's curious about how their company's valued. And valuations for selling a business are not the same as valuations that venture capital players put on your business. They are quite different. So most SMEs are valued on a multiple of EBITDA, anywhere from 3 to 7 times, probably a median number is 4 to 5 times. And this is for, you know, like a B2B services business, IT services companies, consulting businesses, anything like that, okay? This is for non-SaaS companies, okay? And then the other thing that's important is the Rule of 40. You may or may not have heard of that, but it is a benchmark measure of the quality of a business. And it's really, the Rule of 40 means the combination of your growth rate and your EBITDA percentage needs to be 40% or greater. And some private equity firms are even looking at the Rule of 50 or even the Rule of 60 in some cases. So you can't have growth at the expense of bottom line, but you also don't want to be in a flat business that's not growing and very profitable. So ideally, you have a strong growth rate, you know, somewhere in that 15-20% a year range, and your EBITDA percentage is also somewhere in that 15, 20, 25% range. Okay, that's the real benchmark of a good business. Again, this applies more to more mature businesses, not early stage or technology businesses. Other factors that have a significant impact on valuation multiples are customer concentration rates. If one customer makes up 40% of your revenue, buyers are gonna apply a massive discount to your business. Recurring revenue is the golden goose, right? The more recurring revenue you have, or even reoccurring revenue, the better. Buyers don't like project-based businesses or businesses that have really volatile revenues. They want client stickiness. They want low churn rates. And they also look at your industry growth rate, right? Your compounded aggregate growth rate. They're looking for businesses that are not on the sunset of their life cycle, okay? So if you are in I'll use a strange example, the translation business, with people that use translators to translate from English into another language. That's a dying business with AI, okay? So there's going to be no growth rate there, right? So again, these are all things that impact valuation multiples. And of course, generally, market comps are what dictate the multiples for a business. Now, SaaS, let me see if I have a slide on SaaS businesses. Okay, no, so let me just go back. Sorry, so pure SaaS businesses are valued differently. They're generally valued at a multiple of revenue. And these days, those multiples have come down, but the median number today for a SaaS business is about 5 times ARR. But again, that's just a sort of a median number. But the multiples range anywhere from 4 to 8 times today. That number was anywhere from 5 to 20 times 2 years ago. So it can change quite dramatically. It also depends on the size of your business, scalability, growth rates, all kinds of other factors, right? So, but SaaS businesses are valued quite differently. Okay, so if you're a more mature company, you need a succession plan. Businesses that are completely reliant on the founder for survival will trade at a significant discount, or they're going to want to tether the founder to the business for a long time. So if you're looking to exit the business and get out, you're not going to be able to get out unless you have a layer of management beneath you. So you need to create a succession plan. You need to create a plan for your ultimate exit. So again, as I mentioned earlier, you need to think about what your time horizon is for you personally. You want to get out of Dodge in 6 months, or are you willing to work with the business for 5 years? They're very different models. Okay, but you need to surround yourself with good people so the day-to-day management of the business runs without you. If every decision goes through the CEO, number one, it's a high risk factor, and number two, you're going to be tough to replace. Okay, and you're going to get a discount applied to the value of your businesses. And again, as I mentioned earlier, put processes in place, playbooks, that everything cannot run through you. So ideally, you have a layer of management, and then like the ideal scenario is the CEO works on the business and does strategic things, not in the business and does day-to-day operational things. Okay. And then you need to align your management or your succession plan with your departure. And ultimately, the best thing is if you've got a successor that you've groomed, because it's a pain for a new buyer to bring in a new CEO and go and find that it's a risk factor. So if there's a logical sort of COO or someone or a CEO in waiting, that's the best scenario. And I'll give you an example. We just sold a company where the CEO is in his early 60s, and he truly, really just works on strategic processes. He has a great layer of VPs underneath him that run the business. And he told the buyer, I want to get out, I want to be out of the business in a year. And they said, that's perfectly fine, because you're set up for that. Okay, and this is my last slide, and we're running on 40 minutes. So create an exit plan. If you're truly serious about exiting your business, decide what time frame and then work backwards from there. So if you want to sell it in a year, you're probably already a little bit behind the 8 ball. But I think a good time frame is about 2 years, and that gives you enough time to make structural changes to your cap structure, to your corporate structure. It allows you to pretty up the business, optimize processes and financials, and ultimately get the best valuation for your business. And you need to engage your advisors early and start mapping out what you need to do. So talk to your lawyer, talk to your accountant, talk to your M&A advisor, talk to your financial advisor really, really early. Like I said, at least 12, but preferably 24 months ahead. The last thing you want to do is start doing cleanup stuff when an acquirer comes knocking on your door. And this is going to happen. It happens all the time. I see businesses that, think they want to exit down the road, but they put it off. An acquirer comes knocking on the door, and then they have a, pardon my expression, but an oh shit moment of what do I do next? And now they're scrambling to get advisors, they're scrambling to clean up, their legals, their employment agreements. You cannot fix these things on the fly in the middle of a transaction. Okay. So you have to build in an exit plan with action items, timelines, metrics, no different than a go-to-market strategy or a growth strategy. So create a small sort of exit team to help you exit or plan your exit and figure out what external resources you need. And you need to measure your plan yourself against your plan at least quarterly and possibly monthly. Okay, so we're at 12:45. I think that's it for my presentation, but happy to answer any questions.
Terry, thank you so much for that. And obviously, we'll share the slides on the recording with everyone here, so you'll be able to dive into the details if you miss anything quickly. But we'll get into some Q&A, and I think there are a couple folks waiting around to ask some questions. And maybe we'll start with Amanda. Did you want to unmute yourself and maybe just ask directly?
Sure. And thank you, Terry. That was a lot of ground covered. So appreciate the presentation. At one point you discussed, a few points you discussed things that you want to have in order, like the organizations that you have incorporated. And you said sometimes companies have different entities that are incorporated separately, and it makes things messy for this transaction and transition. But I did want to ask about companies who have different columns or different pillars of delivery, like different delivery service models, because I'm kind of the reverse of that right now. I'm one company, but we have 3 pillars, and we're in that stage right now where we're considering branching out into different legal entities, because we could sell them individually in future. So I just wanted to kind of flesh that out a little bit.
Yeah, so if you think, like if you have 2 or 3 discrete businesses that are rolled into one business, it does make sense to split them out. Like I've been in the middle of a transaction where a company has 2 completely different businesses, and if they sell it as a package, a buyer is going to almost completely discount one of those 2 businesses, right? So you're not going to get value for that second line of business or business unit. So you might as well carve it out. Now, there is a way for a buyer to do an asset purchase. Like there's 2 ways to buy a company, right? You can buy shares or you can buy assets, right? In a share purchase, you're buying the shares and you get everything related to the business and all the ghosts in the closet, right? So you can't split things out that way. You can do an asset purchase. So in your case, if you had 2 different businesses, someone can buy the assets of business A and leave business B in the business. The problem is you got a big tax problem, okay? Because you're not using your capital gains exemption because you're probably a CCPC, a Canadian Controlled Private Corporation, and you have a capital gains exemption. So it really, if you do believe there are different kinds of businesses and different kind of buyers, then you need to do that early and split them out. Okay, but sometimes people will have, one person that works in the UK and they'll create a whole company around that person because they feel like they need a whole different business unit, right? So again, it really depends on the circumstances, but ultimately if they are different buyers, then yes, you should split them out. And you really don't want to be doing that on the fly when someone comes knocking.
Yeah, that sounds messy. Okay, thank you.
Thank you so much for that. Marcus, go ahead.
Hey guys, I'm Marcus. I showed up a little bit late. Sorry. Nafis, nice to see you. Terry, I hopped in kind of at the butt end of the meeting there, but I'm actually me and my business partner are actually working on selling our business right now. In the next couple of days, we're dealing with two people right now who are looking to sign exclusive LOIs with us. One of the issues that we've encountered, though, and just a consideration that we are trying to be mindful of, is if we are basing the sale price off of EBITDA, how do we preserve the sale or the purchase price value over a 2 to 3 year buyout? If they're buying a majority stake, so like how could we stop them from, say, introducing debt or hiring a massive sales team so that the revenues actually dip, so that they could acquire our shares at a discount?
Okay, so how big an earnout is it going to be? Like, what percentage of the purchase price is tied to the earnout?
It's going to be about, well, we grew very fast, so it's probably going to be about 7x.
Sorry, 7x
7x of our EBITDA.
is the earnout, or that's how they're going to calculate the earnout? Like, are they
That's
paying any cash up front, or is it all kind of
we're looking to do 65% cash up front, but then a buyout of the remaining percentages
Gotcha,
over
okay.
the next couple of years.
Okay, so there's a couple ways to do it. There's lots of ways to do it, but there's two general ways. One is through the legal agreements, through your SPA. Your lawyer can help you carve out certain, like you can put some handcuffs on the buyer that says you can't spend more than, you can't deviate from our historical ratios, like, X% of marketing on revenue and things like that by more than a certain percentage without our consent or something like that. So you can try and put complicated handcuffs on them for below the line numbers, in other words, below cost of goods sold. But the easiest way to do that is just tie the EBITDA to gross margin. Then you don't care what they do below the line, right? So you still need to make sure that they don't, try and sell everything at low margin, but controlling your margin is much easier than controlling everything below the line, right? So you could just say, well, I'll give you an example. We're doing an earnout right now. So a company has 6 million in EBITDA, and to deliver 6 million in EBITDA, they had about 35 million in revenue, right? And their gross margin on the 35 million was about, trying to remember now, 15 million or something like that. So rather than do previous suggestion I said, we just tied the earnout to maintaining gross margin of 15 million over the next 3 years or something like that. It's way easier to police. And that way it doesn't handcuff the buyer, because the buyer can do anything they want. If they want to dump an extra 5 million into marketing to grow top line, you don't care. And it doesn't impact you as long as you as in management are delivering the gross margin dollars. So that's the easiest way.
It's a little harder for us because I think we tripled in size over the first year, so it's kind of hard for us to gauge, based on historical data, what kind of sale price we'd be looking to preserve. And a lot of, in that sense, it's kind of speculative too, and the investors don't really like that so much. But I do appreciate what you said there. One other quick question is just, how do you secure their interest after they sign an exclusive LOI? So what's to stop somebody, or how do we stop somebody or handcuff them from wasting 2 months of our time when we have 10 other people who are interested, and then not actually committing to a PSA?
Okay, so good question. So, well, the easiest thing is to keep the shortest exclusivity period. How long is your exclusivity period?
We're looking to close in 45 days. After 45 days, it won't be exclusive anymore either.
Okay, so that's really good, because normally I see 90 to 120 day exclusivity periods. So yeah, your hands are tied for 45 days, but I would venture to guess that any of your other suitors will still be there if the 45 days expire. So really what you want to do is, like sometimes in LOIs, we'll build in milestones that says, we need the first draft of the share purchase agreement by X date. or you need to have completed your technical due diligence by Y date, right? Otherwise, exclusivity goes away. So you can build in certain metrics, but 45 days is a very short exclusivity period. So I think you're doing pretty good there. But there are other ways to do that. But again, it's really just milestone based.
Okay. I have a couple more questions, but I'm not going to take up more of your time. I'll let other people ask for now, and I might chime in at the end. Thank you very much.
Yeah, Marcus, if you want, reach out to me, and I'm happy to have a chat with you.
Appreciate it. What is your title? I missed it in the beginning. Like, what have you-
Managing director.
Got it. Appreciate
Marcus,
it. Thank you very
we'll
much.
share out the slides and the contacts after,
Thank
so
you, guys.
you can definitely get in touch. I see one more question in the chat, Terry. This one's from Keek. So do you have any advice for media companies who are providing services and creating original IP when it comes to positioning themselves for a future buyer?
It depends a little bit on what kind of media. So it depends. Are you? I guess it depends if you're sort of producing media for other parties, or if you're building your own properties. The more proprietary media properties you have, the better, because otherwise you're just a hired gun. We don't do that much work in the media space, but I'd have to know a little bit more about the business. But I think in general, the more proprietary media you have and the more recurring revenue you generate from that media property, the better, right? Buyers don't like hired gun type project businesses like, web developers, tech developers, people that build media, things like that. That's because it's tough to be, it's not as scalable and sustainable a business. So I wish I could give you a more concrete answer, but I don't know enough about the business.
Thanks for that, Terry. Oh, that helped it up for Kick. Awesome. So I know we have a couple more minutes with you. Just want to open it up. Anyone else that have any questions? Feel free to maybe also unmute your mic. Sorry, Amanda, did you wave your hand? Oh no. Yeah, Marcus, we'll go back to you. No one else is asking.
Another question. So I chimed in right around the point where you were talking about retention. Myself and my business partner are pretty hands off though. However, we were together, we're kind of pioneers in the industry that we're doing. So they do want to retain us for like 3 years or something. Do you have 3 to 5 years? They want to keep us for as long as possible, but we don't want to really stay that long. Do you have any feedback about an approach to retention agreements, things that might get overlooked? How do we make sure that we're getting the best deal for ourselves? Because we don't actually know how we're going to like the new management, right? I've been the CEO the whole time, and they're looking to replace me in the event that we go through.
So, I mean, I usually tie the employment duration with the earnout, right? If you're going to have a 3-year earnout, you probably want to stick around for 3 years just for your own benefit, because you can have a direct impact on how much you earn out. Otherwise, you're handing the keys to somebody and hoping for the best. But my best advice is, like, buyers typically will understand personal objectives. So I'll give you an example. We sold a little company in Calgary, and both of the sellers were in their 60s. And one said, I'm going to give you 6 months and then I'm out. And the other one said, I'm going to give you 18 months and I'm out. And the buyers respected that. They bought the company in that context and they just planned for it. So, I don't think it's anyone's interest to have indefinite handcuffs on you. And it's probably not even enforceable. Like, you could, even if you have a 3-year employment agreement, you can quit. It's just a question of, are you going to forfeit something on your earnout, right? So I would, my best advice is I'd be open with them and tell them what your personal objectives are, and then you can structure the deal accordingly. But sophisticated buyers understand that, and they will say, look, if we have to replace a CEO in 2 years, then we got 2 years to figure it out. Okay, so I would just be open with them about your objectives and also be mindful of, you want to be around for your earnout period. Otherwise, you're completely powerless, right?
Understood. I appreciate that. I might reach out to you in the near future too. We're looking to sign in maybe 2 days. So thank you again for your time.
No worries.
Awesome. So Terry, maybe just as we're wrapping up, I'll give you one. For the founders here, often we hear from them like how to assess the right advisors, and obviously we know that you need the good advisors around you when it comes to this. So, what are the top questions that they should be asking
Around advisors?
around advisors?
I guess there are two. One is a skill set and one is a industry expertise, right? If you have, so for example, with an M&A advisor or a lawyer, you need someone that does M&A, right? Like I said, a general corporate counsel isn't a great M&A lawyer, okay? Or you don't want someone that does family trusts and estates doing your M&A deal, right? So it's I guess a little bit of a specialty in the M&A sphere, and then even better if they have some expertise in your industry. It doesn't have to be your little slice of an industry, but if you're an IT services company, they need to understand IT services companies versus a marketing agency versus a media company, right? Because their revenue models are very different. So it's really a combination of vertical experience and then expertise in your specific skill set you're looking for. So for example, don't go to your general accountant for tax advice if they don't have a tax expert, right? And so everyone, like the days of being a generalist lawyer or a generalist accountant are long gone. Okay. You need people that specialize in what you need advice on.
Amazing. I think with that we round out the hours. So Terry, just wanted to really thank you so much for the wealth of knowledge that you've shared with our founders today and answering all the questions and with such great insights. Really, really, really appreciate your time. To the rest of you, thank you for joining.